Good afternoon, everybody. Happy Friday. Welcome back to Markets for Millennials for the weekly market analysis from August the 29th through September 2nd. I just want to take an opportunity to remind you to hit the like button if you enjoy the content presented here, and make sure that you subscribe and share this video with someone who might find it helpful. And as we prepare to look at the markets for this week, in terms of the charts and price action, I thought it would be great to go over a few of the economic numbers from the week. I don't know what's going on with my screen there. Sorry about that. But on Tuesday, we had U.S. consumer confidence. I'm sorry about there we go. The consumer confidence, this was a really big deal. The consumer confidence index rose to 103.2, right, from 95.3 in July, and way above forecast too. And so this is an interesting number because it's essentially a survey. It's a survey of consumer expectations, and while it isn't really hard data, it does tell you a lot about perception of the strength of the economy, and the strength in the economy continues to outperform, and even the consumer expectations for the economy are increasing, which was actually a surprise. So we had that on the docket. We had that come out on Tuesday, and then on Wednesday, among the many different things we had the Chicago PMI, which showed steady improvement, just very, very steady improvement, going up 0.1 from 52.1 up to 52.2. And again, this is another indicator of the relative strength of the underlying fundamentals in the economy. So we had new orders and production improving. They do talk about price pressures being acute, and so a lot of the surveys are suggesting that, or a lot of the surveys were suggesting that though numbers are coming in hot, or higher, I should say, or coming in steady, because you want to be above 50 essentially in order to show growth. So there is growth, but there is concern over the price pressures and other issues, potential recession fears that were going on. And then on Thursday, on yesterday the 1st, we had the ISM manufacturing PMI, which came in at 52.8%. And so you actually see that it grew in August, so for the 27th consecutive month, which was a big deal. So it was, I believe it was higher than it was expected to be, but still showing barely overgrowth. And so again, the economy is showing that there is some slight growth, but a lot of people are concerned that this is going to potentially roll over and come down to contraction, and that's something that we need to be watching for in the months ahead. And then the final bit of information, which was this morning, was the payrolls, which rose by 315,000, and a couple of key points here. It was just below the estimate of 318,000, so it was below expectation, or below estimate, I should say. And I mean, obviously lower than what the last month's was, which was over 500,000. But then what the markets keyed in on at first was that the unemployment rate climbed to 3.7%, which was 0.2% higher than expectations, and I believe was higher than last month as well, in the non-farm payrolls report. And then the hourly earnings average was up 5.2% from a year ago, which was slightly lower than estimate. And so all of this information is showing on the charts. It's essentially being priced in as, or it was being priced in as, Goldilocks, which I haven't really talked about anything like that on this channel. But I think maybe it's appropriate as I'm learning more, as I'm growing in my own investing journey and in my own observation, that it would be a good idea to talk a little bit about what that means. And so essentially what you have are basically two main drivers of the economy, and that's growth and inflation. And so what happens is when you have, what I'm saying here is Goldilocks is when growth is up, not too much, but is up, and then inflation is actually coming off. And the market has been, so here's growth, and then here is inflation. Sorry for the bad letters. But what we're basically pointing out here is that what the market has been pricing in actually for a lot of this rise was not really a Fed pivot. It was it was actually the idea that we were going to sustain growth in the economy, but then have inflation actually come down. So if you remember back on August 10th, if I zoom in a little bit, let me get rid of some of these drawings. But if we go back to August 10th, and we go to this candle, this really big candle. I'm on the S&P 500. It was over 2% candle on that, which obviously we've come off from there since then. What the market started to believe was happening, what the market definitely had been convinced was happening, was that we were actually going to see inflation come off considerably, and but then because we had numbers like our manufacturing numbers at 52.8%, our PMIs in the 52 range, showing slight growth, like that was actually was actually being read by the markets as being a positive sign. And so what you are seeing here is because there is so this number, if it was really high, then that would obviously most likely equate to or that could potentially lead to inflation, or if it was supported by sustained high inflation, then that would not be good. You'd be in an inflationary regime. But because on this CPI report, the rate of change of inflation was coming off a lot, that was signaling to the market that we might actually have this growth with this like upwards growth with lowering inflation regime. And so that's what had been going on. And then obviously what we've been tracking technically is basically the market kind of changing its mind about what's important to it at the time. So what the market was looking for a lot basically during the bounce from mid-June into mid-August, a period of about 2 months, what the market was initially pricing in was peak inflation, and then the market was pricing in an eventual Fed pivot and even rate cuts, which is something that I talked about last week. And you can actually see that if you go to the euro-dollar futures curve, which I don't actually have that on my screen right now. I don't have it pulled up ready. But the essential idea was that the market was pricing in that the Fed was going to pivot and not only pause rate hikes, but actually make rate cuts in 2023. And then as we started seeing a lot of these economic numbers, and not just from this month, but even the numbers from the previous month, as those numbers continued to show not growth slowdown, like that growth was still continuing rather than slowing down. We still had our PMIs above 50. We still had hot jobs reports and things like that, if you recall, over the last few months. The market shifted then into this Goldilocks regime. So previously, here when we had peak fear, what was going on was we had this the really hot June CPI report, which was, I'm trying to remember, it was somewhere over here. But we basically had the market pricing in that inflation was going to start coming off, and we had this recession fear. This was, if you remember during this time, was when we had that discussion about recession in the news and the redefining of what a recession is. So we were at peak recession fear there, but then what the market started to price in back then was that the Fed was going to do the pivot and the rate cut next year in 2023. And then for the second half of this price action, the market was actually pricing in the fact that we were actually going to see growth with lowering inflation. And then for a little while, if I go, let me just find my my yields chart, which is why you got a sustained move down. So what happened right here on the yields? You actually got this move down, and then you saw yields starting to come back up, and that actually can happen in a Goldilocks regime. And so that was something really interesting to note that was going on. But you saw this kind of shift where the market was pricing in Goldilocks instead of a Fed pivot, and then we're here technically on life support now. So a lot has changed over the last few weeks. So if we review, obviously the big one was Jackson Hole last week. I talked about that in last week's video. But even more importantly, the market is now in a position where it's starting to actually price out Goldilocks. And so we've had some whipsawing price action these last 2 days, particularly because the market is having trouble figuring out what to do with a lot of this information that's still showing growth, but it's showing growth slowing, but it's still growth, and it doesn't really know what to do with that. So what's really interesting is yesterday on the S&P 500, we came in, and I'll talk about this because my video today is basically saying the markets are on life support, and we are at very critical support, particularly in equities, among other things. And what and so, but over the last 2 days, like I said, the market hasn't really been sure what to do over these different economic numbers that have come off. But basically, we got rejected. I mean, this, you can explain this price action, the rejection at the 200-day moving average. You can explain that as just coming in too hot. This move was so hot that it needed to come off. And this is something, if any of you who follow me on Twitter, I've been talking about this. I had been expecting through this whole rise that we would get a kind of a sharp sell-off. And I mean, it wasn't huge, but I mean, we're talking that the markets were down almost 5% in 3 or 4 or 5 days. And so I was always convinced that the market was going to sell off or have a couple of down days. And my question was, could price find support? And so you can explain this rejection. It's a typical rejection. I mean, it's not very common for price to come straight up through and then never either retest or to come up and not get rejected, at least initially. And so it's interesting because what I was watching for was if this rejection would come up and then have another go and then break through. It helps, in this case, again, to show you the strength of the resistance, it helps that we had our trend line from the January high and then the March bounce, which was coming in and making this confluence right there. So that was a perfect spot to get rejected. And anybody who didn't think you were going to get rejected here was not paying attention. That's basically that. So it was going to get rejected. It was almost a certainty. I mean, nothing is really certain, but it was almost a certainty in my book, as certain as you could possibly be. And then what was interesting is on our price action here, we were toying with making a new, a new short-term low, because obviously this area right here, we were testing that as kind of a support level. And we actually started to come up, and then obviously the Jackson Hole, we're going to go hard at this for longer, and we're going to fight inflation until we get the job done. The markets hated that. And we've basically been at a point now over the last week where the markets are starting to price out Goldilocks because they're starting to be more and more convinced that growth is going to get slowed forcefully by the Fed because they have to bring inflation down. And so that's kind of where we're at as far as the narratives, I guess, that are driving the markets and market participants. And so with that, we can get a good kind of technical picture of what's going on. And I have all my drawings on these charts, but then I also have the 50, 100, and 200-day simple moving averages because I've wanted to illustrate a couple of things. One, starting with the S&P, we are on life support. Last week I talked about this box that I have drawn and how it's showing kind of a confluence of support connecting these trend lines. So I was, and I've been tweeting about this a lot over the last week, watching to see what price would do when it came down to this level. And because we have a confluence of this horizontal support, which had been resistance and support prior, and also the ascending trend line. And I was expecting to touch and bounce, and we did. But then what's concerning to me, even though we're still closing above the trend line and in the box range, what concerns me if I zoom in here is you can actually see price came up and got right up to the 50-day moving average and then has since been rejected, and we're closing lower than we closed on August 31st. And to me, that's not a good sign. It's not to say that I'm convinced that this line is not going to hold or that support won't hold, but it doesn't look good going into next week. And so we're on life support because there is no guarantee that this is going to break to the downside, depending on, there's the probable outcomes, or the range of probable outcomes is extremely wide, as Darius Dale has liked to say. I feel like he's the only one who I've been hearing saying these things for some time. But basically, there's no guarantee that this is going to break. But if you are more bear oriented, then you're starting to froth at the mouth, I guess, for the possibility that this would break, because I really do believe if this follows through, like I was kind of saying the same thing last week, wondering if we were going to get follow through to the downside, and we did. And so if into next week, and next week we only have a 4-day week with Labor Day, and that's another issue that I'm going to bring up in just a second. But if we break through and follow through, then if we close below this area, I think we're gonna visit the lows, and then what everybody will need to hope for is a double bottom, which then comes back up, and there we go. So that's definitely one reason why the markets are on life support and in a precarious situation. The other thing is, they call it the summer doldrums for a reason. The volume, especially in the later part of the summer, is very low. And what we have to be really concerned about next week, and why this is such a pivotal spot, and I'm just paying most attention to the S&P, but I would say it applies in a lot of ways to the other equity indices and to the other markets as well, is that we're going to come into next week and everybody is going to be coming back from vacation and establishing their positions that are going to take them into the fall and into the winter to finish out Q3 and to go into Q4. And so this is a really precarious spot. It's entirely possible that people come back next week and people are like, okay, I'm ready to go long, establish long positions, and that's going to carry us out of here to making a higher high. Because technically we haven't made a lower low yet. As far as swing lows, we have to get down below that level in order to get that continuation down. And so we could, if they establish new positions and they're to the short side, then we probably will break this and we will probably revisit the lows. But then, like I said, they could establish those long positions. Now, it'll be interesting to see what happens on Monday. What I'm going to be looking for is a place to establish new positions. I tend to not short very much, and if I do, I'm mostly taking the inverse ETF, the inverse equity index ETFs. So in this case, this would be the SH, the short S&P 500, or the PSQ, which is the short Nasdaq, or the RWM, which is the short Russell. So those might be opportunities. So depending on what happens, if you're going to take a short position, then what you want to wait for is the break and a retest. And then what you would probably want to do is a really good spot in this case is to set a stop. And you could even do this if you're trading futures, at where the 100-day moving average is and where the 50-day moving average also is. So kind of in this kind of confluence area right here, which is just above the wick, which is right up underneath the 50-day moving average. That would be a good risk to reward spot. And then on the long side, and you could apply this to the other equity indices. You just have to modify it a little bit depending on which index you're talking about. If you're thinking about a long entry, then what you want to see is price engulf to the upside and retake that 50-day moving average. So you're going to want to see price get right about there. And if it does, then price will also have broken the 100-day moving average. And then what you would want to do is set a stop right below these wicks. And that would be a good risk to reward just in general if you're trading futures, but also even if you're taking positions to the long side on the ETFs, like the SPY and all those different ETFs. So that's kind of the look there. So it's definitely up in the air, and we're going into probably the most important week as far as setting the precedent for the rest of the year. On the Nasdaq, what's kind of interesting is we're getting a cross on our 50-day to 100-day moving average, but to me that's a non-event that doesn't mean anything. The Nasdaq structurally looks the weakest. We do have some light support around 11,771. But we're below, if I put this trend line back, then we're far below the ideal. I mean, we retested that trend line and have again made a lower low on a closing basis than the previous couple of days. So if you wanted to use that as a metric, the Nasdaq has already broken most of its key support. It's below its major moving averages. And so the Nasdaq looks poised to lead the way lower along with the Russell. If we get that break. Although the Russell, you can see we've got this support trend line, which is coming in near a place of horizontal support. You guys see here, I had this yellow line that I drew yesterday, which was kind of a semi-light level of support, and we obviously broke right through that. And look, you can see we have the cross of the 50 and 100-day there to the bullish cross, I guess you could say, and yet price down below both moving averages and rejected if you zoom in by both moving averages. So things not looking good there. Again, life support here for the Russell. And then on the Dow, basically the same picture as the Russell, almost exactly because of the confluence of the horizontal support and the trend line support, as well as the rejection below the moving averages. And so those, the markets, the equity indices are on life support, so you want to be really careful here. The US dollar index, let me turn my moving averages off. The US dollar index has made a higher high on a closing basis. And while everyone continues to look for dollar tops, the dollar hasn't topped yet. And there's no reason, if you're honest with yourself and you're honest with the macro situation, there's no way that you could possibly think that the dollar is topping. If we actually go, let me really quick, I don't have it pulled up already, so I'll just pull it up here. What's really interesting is now we have the euro back below parity, and we started getting some of this positive price action on news that the ECB was going to hike 75 basis points, an unprecedented amount for the ECB at its meeting, which I believe is next week. So that's going to be a high impact news event next week. And yet we couldn't hold it. The US dollar just had an amazing day yesterday versus the euro, 1% move just on that cross alone. And so, I mean, if the ECB hikes 75, I kind of think that that's already been baked in, I think that's how weak the euro is. I think that's how weak the Eurozone is. That I think that, because they started talking about 75 basis points a few days ago, and the market started to come up back above parity, and it's given it all back. So I think that honestly, any optimism relating to 75 has been what got kind of baked in. Now it's entirely possible that maybe there's some disbelief that people don't think the ECB will actually hike that much. So maybe that's part of the issue. But I think I think it's already been considered, and the market has already digested that. So I honestly, like, if the euro, if they do hike 75, I'm expecting the euro to pop, but then to get sold off almost immediately or very shortly after. The 10-year Treasury yield, I've been watching this. It shifted to bullish, the bullish strength and momentum signal, and so that's something that I've been watching for, and I've been beating the table on this. That I think I retweeted this today, that when the market was somewhere over here, I said I feel like the market still is going to have one last move up, and the market is higher than where we were trading when I tweeted that. So Treasury yields, while coming off today on the non-farm payrolls news, definitely still in a pretty solid uptrend on this recent move. And so this is a trend line you could watch on the near term, but obviously the overall trend is still to the upside. And if this makes a higher high than what we saw in June, then I'll probably make a trend line connecting something like that. Not really certain, or maybe I'll do something like this. This looks a little bit better, but obviously that's I'm not worried about that right now. This is the current near-term trend, and so I'll be watching that. If we break down, then I think we'll get a test of this trend line, which right now is coming in around 2.5%, but we will definitely see about that. Gold had a huge move today, and I think part of the reason is because on our jobs report, because you had it was below estimate, and it was the unemployment rate actually climbed. So the market is actually, like, gold will increase, right? And so, I'm sorry. So I'm getting too ahead of myself here. This price action is Goldilocks, and the reason why it's Goldilocks is because it's because growth is being seen as continuing to, or as the economy continuing to be in growth rather than in contraction. And when we get these little pops in gold, gold performs well when growth is lagging, when growth is not doing so well. Gold is a safe haven when growth is lagging. And so we obviously get a pop here because the market, again, is really confused as to what it's trying to price in. We've been in Goldilocks, and yet it doesn't seem like the market is convinced Goldilocks is going to stay there, and gold popping right here is evidence of that. And it helps that gold is kind of, if you're a gold bull, you want to hope that this is a double bottom. I mean, it looks like it's going to be a perfect double bottom, but obviously anything could happen. We have not yet gotten below the wick that we tested on the 21st of July, and we didn't close lower than what we saw on the 20th of July. And so if you're a gold bull, you're hoping that this is a double bottom and that we break this trend line that's coming in. And so we'll see. If growth really is going to slow down, then you'll see gold come back up, and if growth continues to stay above par, then you're going to see gold come off and make lower lows. And silver, for that matter, already did make lower lows. So that's worrisome. Let's take a look at crude oil. Crude oil looked to me last week like we were, getting ready to make, getting ready for a move higher. Wasn't sure where it was going to go. In fact, now as I'm looking at this, I'm starting to wonder if we're going to see if this is a channel that we're in. Doing this in real time, sorry. I don't know. I don't know. We'll see. I'll make it just in case. It might work. We'll see. So we are on a confluence of support, though, horizontal. You can kind of see it from our top, the swing high on October 22nd. That's the green line, and then trend line, which is connecting some swing lows. So we're at a confluence plus the confluence of the breakout of the descending trend line here. So we were pretty high on the day, and then we've kind of sold off we've kind of sold off throughout the rest of the day as the market was digesting what was going on. And so the market was really liking growth until recently. So not really sure what's going on with oil. I'm not super concerned because I actually think in the long run this is rounding. That's what I think is going to happen. But obviously, price has to follow through with what I'm saying. So it's something I'll be watching. And then Bitcoin. Bitcoin is holding above its June 19th closing low, but we are not far away. It's pretty amazing to think that we're not that far away from that level. Still well below the trend line, which marks, in my opinion, when you break this trend line, that's going to mark the perfect buying spot as far as a new bull market would be concerned. So what I'm looking for, let me just, on my Bitcoin chart, let me get rid of that for a second. What I'm honestly watching most for is I'm watching for price to potentially cross this orange line. Those of you who have followed me on Twitter, I've posted about this. This is my MRT, which is a multiplier and reduction tool. So every cycle, in short, those of you who don't know about this, every cycle price has touched and crossed the orange line. We did not quite get there. We were really close, didn't quite get there back in June. And then as soon as we came back off and got below the yellow line, I was worried that we were going to come back down. And so I'm patiently waiting with some dry powder just in case we get that cross. But otherwise, if we cross, that's where I'm going to be leaning in pretty heavily because the risk to reward is going to be life-changing at that point. And I'm just sharing with you what I'm doing. Obviously, this is not financial advice for you. Or the other one would be as soon as we break out from this trend line. Once we break out from, that was really bad, there we go. Once we break out from this trend line, then that would be another optimal spot as far as a risk to reward standpoint. Because if you go back and you mark previous bear markets, whether it be if you want to go in the 2017 to 2018, if I could actually do this for once, if you bought there, then obviously you're golden. Or if you want to go from here, if you want to include the 2019 rise, let's see if I can get this right here. Sorry, I'm trying to do this in real time. This is really sloppy. I don't know why my chart won't grab it. Let's just do that just for the sake of doing it. I mean, like if you bought there, then obviously that's still, it's not nearly as good. It's 3 times the price, but still that's life-changing if you're able to buy off that breakout. And I could do the same thing going back even to previous cycles before that. Whether you want it to be, whether you want it to be something like that or something like, let's see here, something like that. If I could get this, there we go. So like that would have been a good spot. And obviously, price does go lower in some of these instances, but we're talking about, going back then to where price ends up being. I'm just saying that's the way that you have to kind of think about it. So you have to be really disciplined. You have to wait for the breaks that show you it's time. Unless you're just convinced over the next 4 to 10 years that Bitcoin is going to be higher in the future than where it is right now, in which case then just close your eyes and buy. But again, that's kind of the way that I'm approaching the market. And so that's where I'm going to wrap up today. Thank you for tuning in. Again, if you've made it this far, I appreciate you watching, and hopefully you found this helpful. Go ahead and hit the like button and subscribe if you are not already subscribed. And I will see you guys next week. Enjoy your long weekend.